Thanks for watching our Infrastructure Quarterly Update. Today I have Ben McVicker and Offa Carliner, Portfolio Managers of the Infrastructure team. Welcome, Ben and Offa.
Hi, Adrian.
Hi, Adrian.
Ben, you've delivered some solid returns over the 12 months to 30th June. What have been the drivers of this return?
Yeah, sure. Thanks for asking, Adrian. So as you know, when we think about infrastructure, we have a couple of performance objectives in which we're trying to hit with the strategy. And those are, we're looking to deliver a reasonable rate of return, which in our world we believe means CPI plus a 5% real rate of return. And in that context, we think importantly, the other part of our performance objectives are to deliver very solid downside protection. So we think when people invest in infrastructure, ultimately what they want is a reasonable rate of return and good protection in that return. And so in context of the last 12 months, we're pleased to be able to report that we've exceeded that performance benchmark. If I can maybe step back and unpack a little bit as to what's driven performance over the last sort of 12 months. I think it's kind of three things, the way I think about it. The first of which is when you think about the assets of the companies we actually invest in, the businesses themselves, they've continued to perform quite well. So what you've seen over the last sort of year is almost this investment thesis. It's the structural growth stories in infrastructure playing out. So if you think about airports, passenger growth has been robust, toll roads, car and truck volumes have been robust. What that means for us is that you get increased cash flows and ultimately investment returns and asset values have benefited from that. When I actually then think about the market performance as to what's happened over the last year, I kind of divide the last sort of fiscal year into almost two halves. So the first half, which is really about downside protection, there wasn't a lot in terms of gross return over the period. What you found was, and really when I'm talking about downside protection, I'm talking about that fourth quarter. If you remember that fourth quarter where the market, the MSCI index in $8 terms was down about sort of 13%, that order of magnitude. During that period, we're never happy to report in negative returns, but over that period, we're happy with the downside protection. So the infrastructure strategy in $8 hedge terms was down just over 2%. So the downside protection, I think, worked in that instance. Then when I roll the camera forward to the next 6 months and what happened there, this was a different story. This is where most of the returns from the year have come from. Ultimately, over this period, what happened was, if you think about interest rates and what's happened, they've gone at the long end, so the 10-year treasuries in the US, they've gone from maybe 3.25% to around sort of 2% as they stand today. And that sort of happened over that sort of period broadly. So what that's meant in market terms is that infrastructure companies, which are long duration, safe assets, have benefited. And we've seen that in the return stream. So overall, we're pleased with the outcome relative to what we sort of set out to do with the strategy.
So let's keep going on with the interest rate point. With the likelihood of interest rates being lower for longer, what does that mean for valuations?
Yeah, it's a good question, and it's one, as you'd imagine, we're sort of thinking about and talking about a lot. So as I sort of just said in response to what we've seen over the last 6 months, long rates in the US are kind of at the 10-year level down to about 2%. When we spend a lot of our time looking at what the market's actually imputing, so what equities, infrastructure equities are imputing into discount rates, we think it's a long way from 2%. And so we don't think the market's quite there. Now, for context, what we've done historically in our space is we've said we think rates are artificially depressed, and we think the mid-cycle rates are likely to increase. So by that I mean, we've said that we think a reasonable expectation for interest rates in the US would be about sort of 4% nominal through the cycle. And so then in that context, obviously, the balance of risks has shifted a little bit. So it used to be where we're more worried about just the upside. It is an equal case that sort of the lower for longer rate story could be with us as well. And so in that context, we've been running a number of sensitivities. What I can say about this is that for every 0.5% odd decrease in discount rates, we're kind of seeing about a double-digit increase in valuations. And we've kind of seen some of that play out in the first half. But I can sort of say this much, is that the market's a long way from discounting that 2% sort of spot rate you're seeing in market. So I think what I'm trying to say is in this context, I think infrastructure valuations look reasonable.
Offa, with that backdrop, what have you been doing with the portfolio?
Sure. As Ben mentioned, interest rate expectations are coming down. The Fed's turned dovish. Central banks around the world have turned more dovish. Now, we've held cash in anticipation of rates normalising over the medium term. That thesis is being tested a little bit. So with the expectations that we will have, or there's a case where we have a lower for longer rates. Certainly the elevated levels of cash are probably no longer as appropriate in our fund, as we've deployed some of that cash into stocks. So at the end of last financial year, we were about 8% cash, now we're around 4%, so we've been deploying some of that cash. The other big moves have been into utilities, and particularly US utilities. Now we've thought US utilities have been expensive for a long time. What's happened, particularly at the back end of last year, we saw big declines in utility prices as rates spiked in the US. That gave us an opportunity as long-term investors to go out and purchase these assets, these companies for what we thought were attractive valuations. We've actually added quite significantly to those positions. We went from around 28% to around 40% in utilities, largely driven by the US utility portfolio. That's also been funded not just from cash, from a reduction in things like communications. So communication stocks have run up very aggressively this year, so we've taken some profits from those, redeployed it, and from things like the Morandi bridge collapse that led to us exiting Atlantia position, and that gave us some additional cash to deploy. So we've reallocated from those stocks back into the utility space, and utilities are really leading the keel for the portfolio. At a regional level, we've moved more into the US, and that's been driven by this shift to utilities. It's the biggest opportunity set there, but also we've benefited from really good performance in our rail holdings. We've also increased our weights to Europe. Now that's been driven by a number of factors. First, the good performance in particularly Italian utilities. So they're up around 25-30% this year, as well as adding to positions, particularly in European airports, where we've seen specific cases where the stocks have overreacted to short-term negative news. Things like AENA and Fraport, which have given us really good opportunities to deploy capital at attractive valuations.
So speaking of utilities, we noticed that one of the largest positions is a US utility, Atmos Energy. Could you talk us through a bit about that company?
Sure. First of all, let's step back. And for those of you who haven't seen Gerald's recent presentation, we have it on our website. It's a really good background as to how utilities work and how utilities make profit. In summary, the management team has two real levers to pull to maximise profit. That's deploying capital through CapEx and also minimising operating costs. Now, Atmos is the biggest pure play gas utility in the US. It has around 3 million customers across 8 states. It has a very big CapEx program. So over the next 5 years, it has around $9 to $10 billion to deploy. And that means around 14% annual growth in rate base. They obviously get a return on that rate base, that invested capital. When that translates to earnings and translates to dividends, on management's assumptions, we're growing at over 7% per annum over the next sort of 5 years. That's only part of the story. So what's driving this? Normally we see rate growth as a bill growth as a risk in terms of a handbrake to the ability of utilities to deploy capital. On some very conservative assumptions that Atmos has, and they're based on things like very low gas prices, which we've seen prevailing in the US, being driven by the shale gas revolution, which we expect to persist going forward. They estimate in 2023 that after this $9 to $10 billion CapEx program, bills will be about the same level they were in 2008. That's before we adjust for inflation. Adjusting for inflation, it's 20-25% below where they were in 2008. So really, bill prices aren't a handbrake on growth. The other thing to think about is regulators around the US have been very, very focused on safety. We've seen some big accidents in the US in terms of gas pipeline explosions, the biggest being San Bruno in 2010. That's given them a real focus on safety. Now, Atmos has around 28,000 miles of pre-1970 pipe. And 1970 is important because pre-1970s there was no regulation as to what goes into the ground, the quality of the pipe. So they have bare steel, cast iron, vintage plastic, and all that needs to be replaced. So even after you spend this $9 to $10 billion, you're still going to end up with 24,000 miles of pipe that needs to be replaced. That means a really long runway of CapEx and earnings growth to come into the future.
Thank you, Ben and Offa. And thanks for watching our Infrastructure Quarterly Update. As always, please feel free to share this link with your clients and colleagues.